Can selling cash-secured puts actually fill a retiree's monthly income gap? That is the question I want to test over the next 12 months. This is not a backtest, and we are not going to use Hindsight. This is a live, forward-looking experiment consisting of 12 put-selling cycles with the rules established before the experiment begins. Starting with closing prices on August 24th, 2026, and continuing through August 20th, 2027, every trade will follow fixed, predefined rules published before we take step 1. The market numbers are still blank today, but the rules are not. We will begin with a hypothetical $1 million portfolio, establish the monthly retirement income gap, explain why SMH was selected, and then go through the execution rules, assignment ladder, and monthly scorecard. Now, the hypothetical $1 million portfolio is divided into 4 parts. 20% goes to Vanguard Value Index Fund, VVIAX. 20% goes to Fidelity Dividend Growth Fund, FDGFX. 40% goes to Fidelity U.S. Bond Index Fund, FXNAX. The remaining 20%, or $200,000, stays in cash to support the cash-secured put strategy. The exact fund unit counts are intentionally blank. The live closing net asset values on August 24th will determine those numbers. I do not want to use today's values and later pretend they were known in advance. The allocation is fixed before the experiment begins, but the exact number of units will be determined by the market on August 24th. The $200,000 cash reserve remains available for the put trades, while FXNAX also provides part of our monthly fund distributions. So, why these 3 funds? VVIAX and FDGFX carry 4-star Morningstar overall ratings, while FXNAX serves as the 3-star core bond stabilizer. Their historical returns help explain why this starting mix was selected, and these are also funds that are part of my personal portfolio. But past ratings and past performance do not tell us what will happen during the next 12 months. They simply establish our starting portfolio before the live experiment begins. Now we come to the retirement income problem itself. For planning purposes, I am using approximately $4,000 per month as the retirement spending target. The slide also shows the BLS benchmark of $3,701 per month. The average new Social Security award at age 65 shown here is $2,028 per month. Using the $4,000 planning target, that leaves a monthly income gap of $1,972. Part of that gap can be supplied by mutual fund distributions, particularly the monthly distributions from FXNAX. The remaining question is whether income from selling cash-secured puts can help fill the rest. To test that question, I selected SMH, the VanEck Semiconductor ETF. Now, why SMH? It holds 25 large liquid U.S.-listed semiconductor companies, including businesses supplying the infrastructure behind artificial intelligence and cloud computing. That gives the fund exposure to an industry with substantial underlying demand. SMH also has listed options across multiple strikes and expirations, with useful open interest for an experiment like this. The third attraction is the option premium. SMH options can carry substantial extrinsic premium, but that premium is not free money. Higher premium can accompany higher volatility, and higher volatility means real assignment risk. That risk is precisely what this 12-month experiment is designed to expose rather than hide. We will measure what actually happens instead of assuming an attractive premium automatically produces an attractive outcome. Now, let's get into the rules. There are 7. Rule number 1 removes discretion over when we enter. Every opening trade will use end-of-day prices on the 4th Monday of the month, beginning August 24th, 2026. For the selected put, I will use the midpoint between the end-of-day bid and ask as the recorded sale price. That gives us one reproducible end-of-day snapshot, each month, rather than allowing us to select whichever intraday price later looks most favorable. Rules 2 and 3 fix the initial position size and expiration. Each regular cycle begins by selling 2 cash-secured SMH puts, targeting approximately 10% out of the money. Those puts will use the third Friday expiration of the following month. In this experiment, 10% out of the money is based on price, not option delta. For example, if SMH closes at $500, 90% of $500 is $450. So $450 becomes our target put strike, subject to the strikes actually available in the option chain. The calculation is intentionally simple and transparent. We are measuring distance from the market price rather than trying to optimize the trade using hindsight. Now, Rule 4 governs the profit-taking exit. The moment a put is opened, a good-till-canceled limit order is placed to buy it back when only 10% of the opening premium remains. For example, if a put is sold for $13, the GTC buyback is placed at $1.30. If that order executes, $11.70 of the original premium has been captured, or $1,170 per contract before fees and taxes. Rule 5 covers the uncomplicated outcome. If the puts close early through that GTC order, or if they expire unassigned, the process simply resets. 2 new puts are opened on the next 4th Monday. But if either put is assigned, Rule 6 takes over. The regular 2-put cycle stops immediately. The assignment ladder begins, and there is no rolling in this experiment. Suppose both opening puts finish in the money and are assigned. The portfolio would then take delivery of 200 SMH shares. From that point forward, only one additional cash-secured put may be sold on a subsequent 4th Monday, again targeting approximately 10% out of the money. The latter therefore adds exposure 1 contract at a time rather than continuing to sell 2 puts every month. For every 100 assigned shares, 1 covered call may also be sold. The covered call strike cannot be below the assignment price of that particular lot. Rule 7 then imposes the hard stop. No more than 6 assigned puts in total, which means no more than 600 SMH shares. The initial 2 puts, plus as many as 4 later single puts produce that 6 contract maximum. There is also an important capital constraint. At current prices, even 4 assignments could absorb more than $183,000 of the original $200,000 cash reserve. If assignment continues beyond the available cash, capital would have to be released from the bond allocation. If that happens, it will be reported openly rather than hidden from the results. Now we come to how the experiment will be judged. Every monthly episode will report 2 separate dimensions of performance: income and capital. Category A will track net option premium withdrawn from puts and covered calls. Category B will track total mutual fund distributions. A plus B will then be compared with the monthly target of $1,972. Each month, the scorecard will answer a simple question: did these income sources actually fill the gap? But income alone is not enough. The scorecard will also show the remaining FXNAX units, total portfolio value, and total profit or loss. If bonds must be sold to support assignments, you will see it. If SMH shares fall substantially below their assignment prices, you will see that too. Cash flow and capital value will remain separate and visible throughout the experiment. So, the rules are now fixed, but the market will write every one of the 12 episodes. There are no forecasts and there will be no hindsight adjustments. Please remember that this is an educational experiment, not investment advice. Options involve significant risk and are not suitable for every investor. Cash-secured puts can result in substantial losses, and under these rules, could leave the portfolio holding as many as 600 SMH shares. Prices, premiums, fund distributions, taxes, and fees can all change. Episode 1 begins with the August 24th closing data. Subscribe if you would like to follow all 12 cycles through August 2027. No forecasts, no hindsight. The market writes every episode.